Dear friends of Grey Rhino, I'm very happy to be seeing y'all once again.
Many people have been talking about REITs investments recently. So is REITs a good place to be in currently? And if so, what kind of REITs are good to be in? Today, we'll be unveiling the answers to these questions. But before that, I'd like to share in general, what are the things I will look for in a REITs? Firstly, I will look at whether is it yesterday or tomorrow's REITs. Okay, tomorrow's REITs are those that will be thriving in the environment in the future because of disruption. And secondly, I will look at the sponsor. Who is the REITs manager? Yeah, because it is very easy to stuff shady things into a REITs. So I rather will go for someone who is reputable, someone with a good track record, and maybe be willing to accept a slightly lower dividend yield. So what REITs will we be going in today? Let's get started. Okay, today we'll be looking at one of the tomorrow's REITs, which is Data Centre REITs. So we look at the best of the data centers. And we'll be covering, firstly, an industry overview. Then we'll look at the competitors and an investment analysis. And lastly, looking at the risk. Firstly, an industry overview. Okay, this is from Globe News Wire, and it shows that the growth of data centers globally is expected to be 4.5% per year. And then for Asia Pacific, 6%. And the highest growth is actually in Southeast Asia, which fortunately Singapore happened to be part of it. For data centers, there are actually a few kinds of data center. Let me explain. Firstly, we have the co-location. And usually there are multi-tenants within a co-location data center, which is like one of them, let's say they'll take a few racks to put their servers there to operate their data. And then within the whole data center, there could be many tenants. Okay, and the data center will be providing the equipment, and they will also be managing the facility. Okay, but the servers will be provided by the tenant themselves. And secondly, we have the fully fitted data centers. These usually only have one tenant. Okay, so they'll rent the whole data center, and the data center provider will actually provide the equipment, but they will not be managing the facility, nor will they be providing the servers. All this will be provided by the tenants. And as you go to the shell and core, so it gets more and more bare as you go down the line. Okay, for shell and core, similarly, there's only a single tenant, and the data center provider will not be providing any of the above. Okay, so it's basically just the bare building, with the necessity specification, and the rest will be fully furnished by the tenants, and usually the lease will be longer. Okay, so if we look at just the co-location markets, well, this is the growth per year. Okay, for North America, about 6.4% per year. Emerging markets, 11%. Asia Pacific, 12.2%. And again, Southeast Asia is expected to have the highest growth rates of 12.9% per year. And that is a very fast growth rate. So today, we would like to look at, there are not many data center REITs globally, actually, as I was looking at them. So Singapore happened to house one of the pure play data center REITs, which is Keppel Data Centre REITs, okay? In short, Keppel DC REITs. And I'd like to compare firstly to a peer-to-peer comparison globally to see how attractive this Keppel DC is, or are there more attractive ones? Okay, so I compare to a few. Okay, Equinix is the largest data center REIT in the world, in US, okay, and then followed by Digital Realty. And I compare some in Australia, Japan, and China as well. Right, so if you look at it based on price to book, okay, the lower it is, the better. You can look at it, Keppel DC is the second lowest in this list. Okay, the lowest being Nippon Telegraph and Telephone Corporation. As usual, Japan companies usually have a very low price to book ratio. Okay, but Keppel DC comes not far behind. However, in terms of dividend yield, currently Keppel DC offers the highest dividend yield amongst the major data center. Okay, and that makes it Keppel DC a very prime candidate for consideration. Secondly, I like to look locally. Within Singapore, there's only one pure play data center REITs, which is Keppel DC. However, Mapletree Industrial is gradually growing its data center portfolio. Right, and today its data center makes up about 40% of its total portfolio. Okay, and it has other industrial properties like the high-tech buildings, business park, so on and so forth. Okay, and if you look at the geographical diversification, Keppel DC has a broader diversification with about 66% in Singapore, and the rest in other countries in Europe, and some in Australia and Malaysia. Mapletree Industrial is a lot less diversified in my view. Okay, so it's largely in Singapore, and it's got 35% in North America, and these are all the data centers. Okay, so the bulk of Mapletree's data centers are situated in USA. Okay, let's look at this comparison and to see which one will we prefer among the two. So we look at firstly the key financial metrics. Based on price to book, okay, Mapletree Industrial has a lower price to book, and that makes them the winner. And in terms of property yield, it means for the same property, which one gives a higher return? And you can see from here, Keppel DC gives a higher return on their properties, and hence we'll give the winner to them. And thirdly, dividend yield. Okay, Mapletree Industrial today have a higher dividend yield of 4.2 compared to 3.8 of Keppel DC, and hence we'll give the winner to Mapletree. Let's look at next the credit metrics. Okay, there's this thing called WALE. What does it stand for? It's weighted average lease expiry. Which means because for the tenants, they're locked into the REITs, okay, or rather the leasing of the property. So the longer it is, the longer the visibility. Which means, for example, for Keppel DC, on average, for the next 6.5 years, the tenants is contracted to be leasing the property. So that gives them the visibility of the next 6.5 years of rental. And in this aspect, Keppel DC wins out, given a longer lease. And next, the portfolio occupancy. Of course, we would like to see a high portfolio occupancy, which means its properties are in demand. Okay, and this one, I would say for Keppel DC, again, edge out. And we give the winner to Keppel DC. Okay, some other considerations. Firstly, we look at the company sponsor. Of course, Keppel DC is sponsored by Keppel, and then Mapletree Industrial by Mapletree. And which one will we say is better? Okay, in my view, I would favor Mapletree, which is government linked, and the government actually has a good pipeline of properties, which can be injected into Mapletree. Keppel has as well, but I would say that it is not as superior as Mapletree. And I also have to say, for some of the we look at some of the other business trusts and REITs of Keppel, and in my view, they are not as well managed as the Mapletree. So we give the winner to Mapletree. And next, geographical diversification. Okay, so for Keppel DC, we put it as medium, and Mapletree, we put it as low. And hence, the winner, more diversified, we put it as a Keppel DC. And lastly, property diversification. For Keppel DC, is low because it's purely in data center. For Mapletree Industrial, medium. And the winner, we give it to Keppel DC. Why is that so? Because we generally favor data centers, which is one of the kind of property that will grow very fast in the decade ahead. And hence we prefer a pure play data center compared to one that is more diversified. And as a whole, we'll give the winner to Keppel DC. And hence today, the investment analysis will be pretty much looking at Keppel DC, because comparing globally and comparing locally, we think it stands out as a pure data center REIT. So next, we go to the investment analysis of Keppel DC. We look at a few areas that we like about Keppel DC. First, strong secular tailwinds to drive long-term growth of data centers. And secondly, Singapore's strategic location as a data center hub of Southeast Asia. And thirdly, the growth and resilience of the REITs. Okay, so firstly, the strong secular tailwinds to drive long-term growth. Why do we say that? Firstly, there are a few trends in the world. Firstly, data analytics. Today, data is king. And hence, a lot of companies are investing into data analytics so that the data can be mined and become very valuable information and intelligence. And in this, for the next 10 years, it's slated to grow at 25% per year. And that's an extremely fast rate of growth, which means probably every 2.5 years, you will double in the capacity requirements. And hence, data center is the exact place to house all this data. Secondly, cloud computing, which is also a growing trend. And that's slated to grow at about 18% per year. And thirdly, the 5G smartphone, which in a couple of years, Singapore is going to be moving majority to 5G. Today, we are still in 4G. And 5G requires a lot more data. And that's slated to grow at 58% per year. That's an amazing rate of growth. So with all this trend that is happening, definitely there'll be a need to store all this data. And hence data center become very, very key to be the place to store all this valuable data. And that will drive the strong secular tailwinds for the demand for data center. And this is this survey that's done by Gartner. Okay? The enterprises will close this is a survey to see that data enterprises that will be closing their traditional data centers. Traditional data centers means the servers that's housed within their own premise. And in 2019, only 10% says that they will be closing their own internal data center, and then to outsource it. And in this survey, by 2025, up to 80% will want to be closing their own internal data center and house it externally. And hence, data center will be a prime beneficiary of this trend. Why? Because for cost-wise, it's going to cost a lot lesser. Being able to outsource for the economies of scale. Agility, because a lot of these features can be packed into the data centers. And they have the ability to mix and match, to upgrade some of their latest software, and that makes them very agile and very flexible. Secondly, access to resource. Because of the economies of scale, they can be negotiating for the best good people to be managing their data centers and to have the best software. And hence, the access of resource will be much better on a data center. And lastly, the security. Because with all these data housed within the same place, they can then look at investing a lot more to increase the security of this data, which is of paramount importance. Because once there's leakages of data center, nobody will feel safe to put the data into this data center. And this is the reason why many of these enterprises wants to shift their data centers from internally to outsourcing. Okay, and then so next we look at Singapore's strategic position as a data hub of Southeast Asia. As you already saw earlier, Southeast Asia as it is already one of the fastest rate of growth for data center. And the good thing is Keppel DC actually has 56% of the data center in Singapore. And let's look at the right side. Okay, so Singapore has a very strategic position for data center. Firstly, because of its connectivity to the rest of the region. That Singapore has about 6% of the world's cable that is connected to the rest of the world. And that makes Singapore very well connected. And with this cable, there's very high speed of connectivity. And because of Singapore's good corporate governance, it allows ease of doing business, high security. And then because Singapore has also a very low tax rates, and that makes it attractive for enterprises to be setting up their corporations in Singapore. And we have energy stability, like what we have experienced. We don't have intermittence, we don't have gaps. And a very prime advantage is Singapore have very negligible natural disasters. And that makes Singapore a very good strategic position to be housing data centers because they cannot have disruptions to the data. Okay, and hence Singapore is ranked number 2 globally as the most desirable place to set up data centers. And it's the only matured data center market in Southeast Asia, and it currently accounts for 60% of the data center supply in Asia Pacific. So as you can see, Singapore is really vital, as a data center location in the world. And having 56% of the data center in Singapore, that makes Keppel DC having access to this very strategic resource in their REITs. And in Singapore, it's expected to grow at about 18.5% per year until 2024. Okay, a very fast rate of growth. And recently as well, the government has put a temporary pause on new data centers in Singapore because it's consuming too much energy, and too much carbon footprints. And what does this mean to the industry? Well, we think that given the high demand and the current pause of supply, that's going to increase the rental rates of data center in Singapore. And that again is going to benefit Keppel DC. Third, we look at the growth and resilience of Keppel DC. So Keppel DC was listed in 2014 with 1 billion of asset under management. And today it's grown it to 3 billion asset under management. So Keppel DC is not just a stable REIT, it's actually a growing REIT. Okay, and as shared earlier, it's got a 98% portfolio occupancy with a long weighted average lease expiry of 6.5 years. And that gives it a very good visibility, that if you invest today, people will tend to have a visibility until beyond 2025 of a secured rental yield. Right, and data centers as an asset class, tend to be very defensive. It's got longer contract period with automatic renewals and price escalation that's linked to inflation. Okay, that makes it an attractive class. Like during the COVID period, a lot of these REITs were affected, but data center REITs was not affected. Right, and I think it's going to continue to command good price escalation, again because of the limited demand supply. So this is what I said earlier. It's regarded as one of the most defensive segments of REITs. Okay, so it's just briefly to look at it, it's pretty diversified in terms of the kind of tenants on the left-hand side. Okay, split between internet enterprises, telecom, financial services, so on and so forth. Okay. And the co-location facilities, which accounts for 72% of Keppel DC's portfolio, usually has a very diverse clientele. Okay, and that's give it stability by diversification and lease expiries. And the remaining fully fitted and shell and core facilities provided the stability with longer lease terms. Okay, these are usually to single tenants. So because of this good mix, we think it again gives a diversified and resilient portfolio to Keppel DC. Okay, this one I'll cover very quickly, which is to say that Keppel DC also hedges its interest rates and currency fluctuation because not all its data centers are in Singapore. Some are overseas, receiving foreign currencies. And it has a pretty low cost of debt at 1.5%. A large part of it is fixed. Okay, so generally looking at this, I think it's quite safe in terms of its debts. In terms of its debts profile. Okay, so lastly, we want to look at that data center has got a good competitive advantage because it's not easy to get in, especially Singapore, which now has kind of put a temporary pause to new building of data center. Because data centers requires high power, needs capital requirements. So it's not easy to set up one. It requires regulatory approval. And not every place we can set up. It needs to have a place that's got a stability in free from natural calamities, good access to power. And hence not every place can house data center. and that gives it a good competitive advantage. Lastly, I'd like to look at the risk. What are the key risks of Keppel DC? So on the y-axis, we'll be looking at the impact. That means the impact of this risk, which you can look at R3 and R4 has higher impact. Probability is the likelihood of happening. And you can look at, of all this, of course, R3 will be where we want to focus the most because it has the highest impact and in our view, highest probability. Okay, so for R1 is cyber attacks and cyber security risk. Because as I said, if a data center is susceptible to cyber attacks, it will lose its reputation and nobody dares to put its data with this data center. And R2 is competition from other emerging Southeast Asian markets. We don't see it as high probability at this moment because Singapore really stands out as the only mature data center location in Southeast Asia. Okay, and thirdly, we like to look at the key risk. This is something very recent, where Keppel DC has some shifting away from a pure data center, which is not something we favor. Because recently Keppel also acquired M1, and Keppel DC actually did some project financing for M1. Currently, it's a very small portion of their assets, which caters for about half a year of their income. So currently, we are not very, I would say, concerned because it's a small portion. But if it gets larger, then that's where we will be concerned. Okay, and then for R4, which is a customer concentration risk, because the top customer currently contributes about 39% of their revenue. But currently, because of the high demand for data center, we don't put it as a high risk. Okay, so for now, we'll look at a summary financials of Keppel DC. Okay, so the distribution per unit growth is about 8% per year. Okay, that's pretty fast. And the distribution yield is 3.8% currently, which means if you invest today, you will get about a 3.8% dividends. Plus, if you use historical as an example, it might grow at about 7 to 8% per year. Okay, the rest of it, maybe I'll just leave it to you to take a look. And we move into the last part of it, which is the exciting part. I call it the yes, no, yeto. Okay, yes means we'll put it into our portfolio. No means we won't put it in our portfolio. Yeto means yet to put it into the portfolio. So does this get a yes or no or yeto? For us, we'll put these REITs as a yes. Okay, what this means is we'll put these REITs into the portfolio. And at the end of the year, we'll review, for all the companies in the portfolio, how has it done? And then we will gain greater intelligence from it. Okay, so we hope this is beneficial for you and do continue to follow us. We'll be doing a company analysis every month here on. And at the end, we'll always say, is it a yes, no, or yeto? So that we can continue to beef up this portfolio over time. Okay, lastly, this is what I have to share. So what I have been sharing today, is really just my analysis of the company and sharing with you what I will do to this company. And it is not an advice whether to buy or sell this company. So if you like to know whether you should have this company in your portfolio, you should be looking for your financial advisor to give you advice based on your personal situation. Okay, so with this, I'd like to end today's case study, and I hope that it was an entertaining and enriching session for you. So till the next time, I'll see you. Bye-bye.
If you'd like to be listening regularly to the Grey Rhino YouTube to gain more financial knowledge and also investment wisdom, do subscribe below to the Grey Rhino YouTube channel and remember to turn on your notification.